I'm Louisa Stephens, and welcome to the fifth installment of Financial Intelligence. In this series, we've been talking at length about creating time and money leverage, because one of the important things that a lot of us think about is starting to create the time in our lives and the money to do the things that we want with our loved ones. And that's often a challenge for most people because we're often stuck in our jobs, or we're stuck in our businesses generating a living. In the last two episodes, we spoke about ways of generating money using network marketing, as well as starting or buying a business, because those are very good opportunities in order to start increasing the amount of cash flow that you're generating in your life, so that you can start then putting money towards your future. Now, once you've started generating more money using the methods that we spoke about in the last two episodes, it's important then to start putting away the excess cash flow that you're generating in excess of your day-to-day needs, so that your money starts working for you. So what you need to start looking at then is starting to invest your money. Once you start investing, you start taking advantage of the compound effect. Your money starts working for you whether you're there or not. Then instead of you putting more hours into your day to generate more money, then the opportunities that you've invested in create more and more money, whether that is through interest, dividends, or compound growth, and so forth. Now, investment is a very, very large field, and many people, get very confused just because of the sheer array of choice that is available as investment vehicles. There are many different things to invest in. The most common thing that a lot of people think about when it comes to investing is saving some money in their bank account and generating interest from it. That is a good way of making sure that you don't spend more than you need and save for a rainy day. But there are a lot of other opportunities, such as investing in stocks, investing in bonds, investing in currency or forex, investing in derivatives, investing in mutual funds, as well as real estate. Now, each type of investment vehicle requires you to learn about, what it is, what it involves, how you invest in it, and what to look for as signs to invest in that particular vehicle. As an investor, one of the things that are important is actually investing in your own education to start with, because even though you might have someone that invests on your behalf, it's very important for you as an individual to know what you expect out of your investments, so that you can be knowledgeable about how you allocate your money towards different investment vehicles, and to understand as well what you can reasonably expect as a return out of those investments. Now, let's first look at investing in stocks. When you invest in stocks, you invest in stocks for the dividends that you get paid from the company as the company starts doing well. Those can get paid on a quarterly or semi-annual or even annual basis, as well as the capital appreciation as the value of that stock increases. Everyone is probably aware of the stock prices that get reported every night. Companies like Apple, companies like South African breweries, many companies that get reported which are listed. Now, listed companies are an easy avenue to start investing in, because all you need to do is to have a broking account, so find out where you can get a broker. A lot of banks these days offer retail broking opportunities, whereas an individual investor, you can open an online stockbroking account and start investing on your behalf. But of course, if you're doing it on your own, there is some education that is required of you, so that you can know when to invest, what stocks to invest in, and when to invest in those stocks, as well as when to exit. If you don't know how to do that, perhaps you might want to have a mandated account with a professional investor who would invest in stocks on your behalf. Bonds is a second way of investing. When you're investing in bonds, you are investing for the interest that is generated as that money is lent to the issuer of the bond. And the value of the bond may appreciate or depreciate depending on whether interest rates rise or fall. The value of a bond has an inverse relationship to movement in interest rates. And the growth is dependent on, there is a formula that is attached to that. So you would need to understand how bonds are valued for you to then start understanding about capital appreciation of bonds. Now, that is the second way of investing. A lot of people believe that governments, which are sovereign entities, they are risk-free. But in this day and age, you need to be aware that countries do go bankrupt. In the last year, we heard about the woes of the European Union when countries such as Greece and Spain were in financial difficulties. Bonds are not as risk-free as they were before. So you need to be aware of that when you're investing in bonds and understand that there might be issues with timing of payment, or a government may even go totally bankrupt. So they are not totally risk-free. However, they are a valid choice of investment, especially for people who have a much shorter time horizon before they require their money, such as people who are very close to retirement age. Currencies and forex, that's another favorite area of mine, for investment. I'm a currency and forex trader myself, and it's a new learning curve to start learning how to trade currency and forex. For currency and forex as well, there are private institutional investors who are able to invest in that basket of investment for you. However, the amount of capital required for you to be able to access that pool is much larger than normal. You would require something in the region of 100,000 to 250,000, or 10,000 to 25,000 US dollars in order to be able to enter that if someone is investing on your behalf. With currency and forex trading, you need to be aware of the higher level of risk that is attached to that asset class. If you are much more risk averse, then perhaps you need to stick to stocks and bonds, which are much safer investments than currency and forex. As you develop as an investor, one option that you might want to consider is derivatives. Derivatives is basically having another underlying instrument, such as stocks or bonds or even currency, in order to leverage the particular risk. As an example, when you're looking at stocks, options are a derivative of, just basically investing in a stock. And another option that is available is futures. If you look at indices of exchanges, for example, the S&P 500, you are able to buy an S&P future or sell it, which is a derivative of the S&P 500 index. That is also a leveraged form of investing that requires further information and further knowledge. However, instead of you then having to choose a particular stock that you want to invest in, you would choose a basket. For example, the S&P 500 that you'd be investing in, or the Aussie 40 that you'd be investing in. Alternatively, if you're not looking at index trading, perhaps a mutual fund might be a much better opportunity for you, where you parking your money in a mutual fund that does your investment for you. As an investor in a mutual fund, please be aware that mutual funds don't necessarily pay you for making money. They get paid for beating a benchmark. So beating a benchmark means that they've beaten the average, which may or may not have lost money. So it's important to become aware whether, if you're investing in a particular type of mutual fund, whether they're actually creating value or whether they're destroying value and still charging you fees for that. Real estate is the last, option, that I'll talk about today for investment, although there are many other types of investment. Real investment is investing in fixed property. When you invest in fixed property, you invest in a property which will earn you rent. Or, of course, you can buy a property that you can fix and flip for profit. When you're starting out in investment in property, because of the amount of capital that's required to invest in property, for you to start generating an income, flipping might be a good starting point because you create a capital base. And once you've got a capital base from flipping properties, that you can look at investing properties and start earning rents on a long-term basis, which is a regular monthly income. An income that will continue growing over time, as you hold that particular property, and eventually you may want to sell that property. A lot of people love property because it's a physical asset that you can feel and touch, whereas you can't touch a stock or a bond or a derivative and so forth. And many fortunes have been created on the back of real estate. I've given you a little bit of a flavor about investing. It's very important that you start looking at that so that your money starts making money for you. And once you've got your money making money for you, then it's time for you to make yourself redundant so that you can start living the life that you enjoy. In the next installment, we'll be talking about the last subject, which is making yourself redundant. And I look forward to seeing you then.